All right, we're gonna get started. First and foremost, thank you all for jumping on here. I see a lot of people still jumping on, so they'll have to catch in as we go here. Like I said, we had 2,000 people, federal employees registered for this event, so usually around this time things get clogged up. But thank you all for being on. We've got a lot of information to go over, and this is one of my favorite topics to talk about. I know it's early in the year, taxes are on everybody's mind. There's some changes that happen going into 2024. The thing is that this year and going into next year are two of the most important years that we may ever have in tax history. That's a very bold statement, I know, but I'm going to tell you the reasons why. But we have an incredible open window of time for people to make changes, people to to really take advantage of the tax codes, because is in January 1st, 2026, so in 2 years from now, if nothing changes in Congress, and I'd write this down because I'm gonna tell you when to take some notes as we go, but if nothing changes to the tax codes, come January 1st, 2026, we have what's called a sunset provision. And I'm bringing that up because a lot of what we're going to talk about today revolves around that and some of the strategies to really take advantage of the tax laws. Um, but the sunset provision essentially means that if nothing changes, we do revert back to the 2016 tax tables. And that means more tax, less space between tax brackets. That is such a significant piece to what we're going to talk about today because we're going to go through all the changes, the top 10 tax mistakes people make in retirement, and even while you're working, things to consider. Now, if you've ever been a part of a MyFed University webinar before, welcome back. If you have not, welcome. We tend to do things a little bit differently than probably most federal workshops. We really kind of give you a broad range of a lot of things when it comes to taxes, but our goal in every single workshop that we do is to simplify taxes and simplify any topic that we do. But today we're going to talk a lot about taxes, and I'm going to share with you some of the common mistakes that I have seen a lot of federal employees and even private sector employees make over the course of my 15-year career as a tax advisor, as a financial advisor. I've seen a lot of changes that have come, and people have either taken advantage of them or they have not. So what I want to do is I want to just equip every one of you today to be able to really take full advantage of what the tax laws kind of give you, but make it very simple because I want you to see how this all affects you today and late into your retirement. So again, thank you all for joining. I still see a lot of people jumping on here. Thanks for joining. My name is Ryan Polimeni, and I've had the privilege of teaching federal workshops now for MyFed University for over 15 years. It's been my privilege. Actually, we've taught this from anywhere from New England all the way to San Diego, California, and everywhere in between. So, I've had the privilege of flying around and doing these workshops live, especially before COVID. And I still do have the privilege to teach these workshops for several of the VA hospitals throughout the United States. And we do a lot of work with NASA, so anybody on NASA, we do a lot of work with your agency as well. But again, we're going to take a deep dive into several different topics today around taxes. So just before we get started, I want to give a couple quick disclaimers. You're going to hear me talk a lot about taxes today. Just a disclaimer, I am not a CPA. I have several that work for me. You're going to hear me talk about things like estate planning and how some of the tax laws changed on there. Again, I'm not an attorney. We have attorneys that work with us as well. But just a disclaimer, everything that we talk about today is general information. So before you make any changes to anything financially, please make sure you speak to someone who's qualified. We have an entire team here at MyFed University to be able to handle a lot of your questions. And I know that throughout this workshop, the next hour or so, I'm going to probably create more questions than you're coming in with. So what I want every one of you to do, because again, this is not we're not in person here. This is live, but I can't take questions as we go. So some of you that are going to have questions, I will not be able to answer them strictly just because of time. So what I want you to do is I want you to write down your specific questions. At the very end of this workshop, there's going to be a form that's going to pop up that you can fill out. Write your questions down, and someone from our team will get back to you personally and answer any one of your financial questions or federal questions that you have at the very end. Okay, that's our commitment to you. So feel free to make sure at the very end that you put that in. If you leave early and you have questions, that form is also going to pop up that you can fill out, and one of us will get back to you. Okay. Just real quick, I want to just tell you about MyFed University, who we are as an organization. and what we represent. So MyFit University is one of the largest federal education companies on the planet right now. They are a government registered entity, and they conduct these workshops several times a year, all throughout the country. Some of them are live, some of them are webinar based, like we're on right now. But last year, I know MyFit University personally educated over 500,000 federal employees. So definitely, we tend to make a big impact in the federal space. And really what we do is we listen to feedback from every one of you to, what topics do you want to hear? What did you like about it? What can we do better? So, a lot of what we talk about comes from that. Now, MyFit University as an education company is actually made up of several former top level federal employees. So we have HR directors that have retired that work with MyFit University to tell us what, their team was looking for, and different topics that you guys are looking for. So, there's a lot of federal employees in the background of MyFit University that help make MyFit University what it is. If you have not had the chance to subscribe to the MyFit University website yet, I strongly recommend doing it. There's just hours and hours of financial content, of federal content that you can plug into at any time. Doesn't cost anything. Great resource for you, the federal employee. Okay. Now, the course objective that we're going to go over today, again, this I wish I had 3 hours to work with you guys on this because it's so much to pack into an hour, but I really think you're going to get a good high-level overview of things to think about. Now, my job is to make you think a little bit differently than maybe you've thought in the past. If you've been to one of our workshops before, you know that we get people thinking differently, and really asking different questions, kind of take a different angle to it. So we're going to talk about things like your IRA distributions and taxes, how that affects you both short-term, long-term, Roth IRAs and conversion, Social Security, the changes to 2024 tax tables and how that affects you, how to make a decision on should I go Roth versus traditional. Now, that's a whole nother topic in itself, but I'm going to kind of hit on it quickly as we go. We're going to talk about the silent killer of people's retirement, which is actually the required minimum distribution and the tax on that. Because I know on this workshop, again, there's 2,000 of you on here. Some of you are just getting started in your career. Some of you are getting ready to retire. I know we had people reach out to us earlier today that was like, hey, I'm retiring in a month. I want to listen in. So we have everybody. So something on this is going to pertain to you no matter where you are in your career. But for those of you getting ready to retire, you want to probably pay attention to a few things that are going to be very important. Taxes on pensions and the Secure Act 2.0, which changed so much when it comes to things like estate planning and passing assets. So again, I'm going to briefly touch on that, but these are things that we're going to really hit on today as we go. Now, tax planning can be difficult. So again, I run a tax firm. I've run it for over a decade now here in Raleigh, North Carolina. We, between us and our partner firm, we do over 3,000 tax returns a year. So we know a thing or two about taxes. And one of the things that we find a lot is a lot of people that come to our office for either financial planning, for retirement consultation, which we do at no cost. We typically find that there's a lot of moving pieces that are never really connected. So maybe you can relate to this. So maybe you have a CPA, or maybe you do your own taxes, or you have someone that's done your taxes for you, and that's your tax person. Maybe you have someone who's helping you with your financial planning, your wealth management. Maybe you have somebody who's doing your estate planning. One of the things that we always typically find is that all these moving parts very rarely come together in one room to talk about your specific needs. And some of you are saying, yeah, I understand that, because it's a frustrating thing where if your financial planner and your tax person are not on the same page, that could be a difficult process because there's a lot of things that could be missed. And so as you're going to see as we go through today, one of the most important things is to really be able to bring your entire financial picture into one place. Now, let me give you an example. I like analogies here, so I'll give you an analogy. What I want you to do today is I want you to think about your financial piece. Now, it could be retirement. It could just be your finances in general. I want you to think about all of the financial pieces as a puzzle. Now, I don't know when the last time anybody's done a puzzle, right? Kind of a thing of the past. I did one with my 4-year-old a couple days ago. That was a disaster. That's a lot of work with a 4-year-old. But what's the first thing you do? And I know, again, if you haven't done it in a while, think about this, but what's the first thing you do when you do a puzzle? And usually, when I'm doing this live in front of everybody, like, the borders, well, not really. Yes and no, right? The first thing that you do is you actually find the table that you're going to do this puzzle on. And let's just say let's just say it's a 100-piece puzzle, right? You find the table, you open up the box, you flip over the puzzle box, and now you've got 100 little pieces of cardboard all over the table. For a brief second, let's be honest, that's chaotic, right? You're probably thinking, what did I just get myself into? Right? There's 100 pieces of little cardboard all on my table. Am I really going to commit to doing this? What did I, do I want to do this? And it's chaotic. And so a lot of the times, the reason I bring this up is because a lot of people view finances as a chaotic mess sometimes, right? There's a lot of moving pieces. It's very chaotic, just like that puzzle. But if you do a puzzle, the first thing that you do after you find the table and you flip that box, you do the borders of the puzzle. Why? Because the border of that puzzle represents the foundation of that puzzle. And once the foundation is built and it's solid, it's very easy to finish the rest of the puzzle because you're working from the outside in. Have you ever tried to do a puzzle from the inside out? It wouldn't work. It's very, very difficult to do it that way. But as long as the border is done and secure, everything else internally becomes a little bit easier as you go. That's what we want to accomplish today and in the future working with you when it comes to your financial puzzle. Is as long as you've got a solid foundation to work off of, everything else becomes easier as you go. And so today I'm going to give you some of the foundational pieces of financial planning and taxes to work off of today and every day moving forward. Okay, so I hope this is going to be helpful a little bit for you. Oh, let me back up here. So let's first talk about the 2024 tax brackets. Pay attention to this because this changed last year or this year. 25 days ago. These went up. We are in I know sometimes it doesn't feel like this. I know it's weird to hear. We are in the biggest tax sale that we've ever seen in our life. I know that's why I know sometimes I feel like we're paying so much in taxes, but we truly are in a position where taxes are on sale, and we even got a bigger boost of that sale coming into this year. So some of you need to really pay attention to this because maybe you're trying to max out your TSP, maybe you're trying to figure out what the standard deduction is and really kind of lower your tax liabilities. It starts with understanding where you are. So these are the new tax brackets. Now, most of you that we found are typically in that 22% federal tax bracket. If you're single, you're anywhere between 47,151 in income, up to 100,000, 525 in income. If you're married filing jointly, that was a kind of a big boost. They actually put it over 200,000 this year for the 22% tax bracket, which is a big jump from last year. So there's a lot of space. And again, when I bring you back to the first thing that I mentioned, is for everybody to really pay attention to the next 2 years and why they are so important, because this could go away very, very quickly. Meaning, if we revert back to the 2016 tax tables, this whole thing changes and there's less room between each bracket. There are higher ordinary income tax brackets, right? You got 10, 12, 22, 24, 32, 35, 37. That's what's called a marginal tax bracket. Those marginal tax brackets actually change if we go back. So these next 2 years, especially for those of you that are getting ready to retire, these are crucial for you to take full advantage of the tax laws. And I'm explaining a lot as we go, but figure out where you fall in this federal tax bracket, and then we're going to kind of move on from here. But you can see that there's more gaps than ever. So for an example, if you're in a 22% tax bracket, you have essentially from a 94,000 as a married filing jointly, and if before you get to a 32%, which is a total 10% tax jump, you have all the way to 383,000. That's a huge jump. Why is that important? Because for some of you, some of the tax strategies like Roth conversions that we're going to talk about, that's really important to have as much space as possible. So let's talk about the different tax brackets and the buckets of taxes, where you need to pay attention to, and know where you're being taxed. Okay, number one is taxable. Right, so that could be something like your W-2 right now. Let's say you're working, you have taxable income that's coming in, that's ordinary income tax. You have things that are tax deferred, meaning I have my TSP, I'm putting money into my TSP, but I'm doing the traditional TSP, which means that I am deferring my tax to a later day. And then you have tax advantages, because that could be things like Roth TSP, Roth IRAs, cash value life insurance, anything that's got a Roth or tax-free component to it. Those are tax advantage, or you could say tax-free. Then you have this thing called Social Security. Now, Social Security for a lot of you is going to be one of your largest fixed incomes. So it's important to understand how that's taxed, because it's based on this wacky thing called the provisional income formula, which I'll explain shortly as we go. But know the buckets, because the first thing that you need to do whenever you're getting ready to retire, or even just talking finances, is really truly understand what are all the buckets of taxable incomes or tax things that you have going on, and are you taking advantage of each one of them? And I'm going to explain as we go a lot more in depth here. But the biggest thing is figuring out at the end of the day where the income is going to be needed from. And that plays a really big role when, for those of you that are getting ready to retire, where you pull money from has a huge impact on your total tax liabilities, both short term and long term. I'm going to explain as we go. All right. So the first thing that you need to do is become really smart with your withdrawal strategies. So for some of you that are getting ready to retire, one of the biggest things you need to pay attention to from a taxable perspective is your distributions from your TSP and maybe your old 401ks or IRAs. The way that those are taxed can play a huge, huge role in either good tax planning or poor tax planning. And I'll give you an example. We have seen people that have done it the wrong way and have put themselves 10% higher into a tax bracket their first year in retirement, not knowing that they made a few simple mistakes that actually cost them a lot of money. So what we want to do is we want to make sure that you understand how to avoid some of those common mistakes as we go through. But here are some of the changes. So I would write this down. Again, I'm going to kind of tell you, I think, when some of the good times to take notes are. This would be one of them. So in 2024, some of the tax changes were the standard deduction. Now, standard deduction is the gift that the IRS gives you that they allow you to be able to deduct from your taxable income. For a lot of you, that helps lower your taxable income from maybe a 22 to a 12% tax bracket. So you need to make sure that you're taking advantage of this. Some of you, probably about 20% of you, actually do itemized deductions, which means that you actually deduct more than the standard. Again, I'm not going to get into that. I don't have too much time to get into that. But if we look at the standard deduction, if you are a single filer, meaning you file your taxes as a single person, or married filing separately, that didn't really change either. Those your standard deduction went up to 14,600 this year. So what does that mean? That means that if you make 100 grand, uh, you're not paying tax on 100,000. You're paying tax on 100,000 minus 14,600. So that becomes what's called the adjusted gross income. Really important to pay attention to on when it comes time for that, because when you start looking at what you actually pay tax on is after adjusted gross income. So if you're married filing jointly, the standard deduction this year went up to 29,200. It's a nice little jump there. And if you're head of household, 21,900. So every one of these four standard deductions went up this year, which is great for a lot of people because it helps you a lot. Okay. Some of the other changes, the traditional, or I should say IRA contributions in general for you guys in the TSP, this applies to both traditional and Roth. So I'd pay attention to this because that went up this year. So last year, the traditional, or just kind of whatever you're putting into TSP, if you're under the age of 50, you had up to 22,500 last year. This year it went up another $500 to 23,000. So for those of you that are trying to max out your TSP, you can do 23,000 this year into your TSP. And if you're over the age of 50, the catch up remained the same at 7,500. So if you're over the age of 50 and you're truly trying to max out your TSP, you could actually put 30,500 this year into your TSP. Now, you could do either Roth or traditional at that 30,500. Let me explain to you why that is so important. If you went and opened up a Roth IRA on the outside, you can see right below there, the max you can put in is 7,000 if you're under the age of 50. Or if you're over the age of 50, you can only put in 8,000. So one of the advantages of you being a federal employee and plugging into the TSP is you could put in the full 30,500 into your Roth TSP. Let Let me give you another advantage of that. If you look down below where you see the income limits outside of the TSP for Roth IRAs, there are income limits that if you are contributing to a Roth IRA on the outside, you can actually be phased out or not allowed to put more in because of your income. So, for example, if you are a single taxpayer uh, and you make 146,000, anything after that, they start lowering the amount that you can actually put into a Roth IRA on the outside. For example, if you make more than 161 grand, you can actually not participate in a Roth IRA on the outside. With the TSP, one of the greatest options that you have and advantages that you have is you can put in 30,500 if you're over the age of 50 into your TSP, and there is no income limit. That's a huge advantage. So if you take nothing else from this, from a tax perspective, that is massive, because from a long-term tax plan, the more you have in Roth, the better it could be for you, because that money comes out tax-free. Now, if you look at married filer, again, you got a little bit of time, a little bit more, because that's a combined between you and your spouse. So again, huge advantage for you guys in the TSP to take advantage on the Roth. Now, tax mistake, I'm going to start going through the top 10 tax mistakes. Those are some of the changes for 2024, but let's go through some of the common mistakes. Now, again, I'm giving you these mistakes based on what I have seen over 15 years of financial planning. These are common mistakes that a lot of people either oversee, don't know, or don't take advantage of. So I want you leaving here today knowing that these are pieces to your financial puzzle that we need to figure out and get right. So number one is not understanding the taxes on distributions. That's a mistake that I see all the time. For example, I'm going to give you an example. 2 days ago, I was talking with to a federal employee that is getting ready to retire, that did not understand this part, the taxes on distribution. And they said, yeah, I've got, I'm not even going to put it, I'm going to make up a number. They said, I have 300,000 in my TSP. I'm going to take 100,000 of it. I'm going to put it in my bank account, and I'm going to buy a new car. And I said, that's fine. Obviously it's your money. You can do whatever you want. But do you understand what taking $100,000 out of your traditional TSP does to your tax bracket? They said, no. Well, when we did the math, that $100,000 was the difference between their first year in retirement of being in a 12% federal tax bracket to being bumped to a 22% federal tax bracket that year. Think about what that cost that individual for not understanding the taxes on distributions. We see this all the time where people are making, distribution decisions and not truly understanding the full tax, implications behind it. So my advice to you is, when you're starting to think about how am I going to take my distributions from my TSP, think about it. It has to be built on the foundation of taxes. And I want you all to write this down and kind of like put it somewhere where you see it everywhere you go. Okay, write this down. I'm going to go slow, but I think this is one of the most important things you should always be thinking about when it comes to finances. The foundation of every financial plan. So the foundation of every financial plan is taxes. It sounds simple, but so many people neglect it. We've had a lot of people come to us that have, when you have an advisor, and my first question is, okay, well, what's the tax plan? What's the tax plan on distribution? Well, I don't have one. How can you have a financial plan without it being built on the foundation of taxes? Okay, that's such an important variable to all of this. So number one mistake is not understanding the taxes on distributions, especially coming from your traditional IRAs or your traditional TSPs. Every single dime or penny that comes out of those traditional TSPs are taxed as ordinary income. That affects everything. That can affect your how much you pay tax on your pension. That could affect how much you pay tax on your Social Security. So I want you to think about taxes on distribution of your TSP. Think about it like if you go to a pond and you were to throw a rock in the pond, you have this big splash, right? Which is your tax problem, and then you have this ripple effect. That ripple effect is the tax issues that can be caused on all the other pieces to your retirement if it's not done properly, right? Like I just said, that individual that came to us that didn't really understand that, that $100,000 distribution had a monster ripple effect, because that 10% more they're going to pay in tax on that distribution, that 10% also now overlapped and affected their first year of their pension. So they had to withhold 10% more of their pension, which means that that was 10% and more in taxes that came out of the pension, therefore lowering their income for that period of time. It also had a huge effect on their Social Security taxes. So what you do in every one of these pieces has a ripple effect. Okay. Now, number two, tax mistake number two is not taking distributions evenly. So if you think you need income, that's great. Figure out a way, and there's vehicles to do it, but figure out a way to take distributions evenly. And if you have to take a more above and beyond your even distributions, then it's very simple for tax planning. Let me give you an example of what I mean. The first thing you need to figure out is how much income are you going to need in retirement? Now, you may say, Ryan, I think I'm going to need $5,000 to live comfortably in retirement on a monthly basis. Great. Let's say your pension's $2,000 and your Social Security is $2,000. So you got $4,000 out of your $5,000 covered, right? So the next thing you got to figure out is, where's the other $1,000 coming from a month? Now, obviously, it's probably going to come from TSP or from your IRAs. That's great. So how much money do you have to earmark specifically for the purpose of income? And here's another thing when it comes to these distributions that we've seen a lot of mistakes on. It's kind of like a bonus number here, is not having a strategy where you have money earmarked for certain things. Let me give you just a quick example of what I mean. You may have a $500,000 in your TSP, and you say, you know what, I've got some in the C fund, some in the S, some in the G, and that's a diversified portfolio. When I talk about having money earmarked to accomplish certain things, I'm not talking about the funds you have. I'm talking about going through your portfolio and really truly understanding, okay, I have 500,000. How much of my 500K do I need to earmark and kind of move aside specifically for income purposes? Now, you may figure out, okay, I need $200,000 to provide me that $1,000 a month that I need for the rest of my life. Great. Now you have 300,000 left. That becomes more of a long-term strategy for growth. But you have to focus on that income piece first. That's why I'm saying taking distributions evenly is important, because you may have that other $1,000 coming in and life is good, but then you say, you know what, I want to take a vacation for 10 grand. Perfect. If you've got your annuity from the government, you've got your Social Security kicked on, you've got a certain amount of money coming in from your TSP, that's very, very simple for tax planning purposes. So if you need to take 10 grand out to go on a vacation, add $10,000 to your income, where does it put you? Very simple for tax planning. Versus, again, we're talking about the distribution mistake, is I see people take 10,000 one year at TSP, 20,000 the next year, 30,000 the next, then down to 10. Then all of a sudden, every year, your tax bracket looks like a heart monitor, right? It's going up and down, up and down, up and down. Very, very difficult for tax planning purposes, okay? So again, these are common mistakes that we see. So I want to help you kind of avoid some of those. The other thing is not rolling over an IRA correctly. You only have a 60-day grace period. What does that mean? That means that if you have this, TSP and you want to move it somewhere else, or maybe you have an old 401k and it's not moved correctly, if it doesn't go like account to like account, meaning traditional to a traditional IRA, and that goes into your pocket, if you don't correct that in the first 60 days, that entire distribution becomes taxable. I have seen that happen so many times where people do rollovers incorrectly and they have a monster tax bill they get stuck with. So that's a mistake that we see often that needs to make sure you're doing it the right way. So if you're going to do any type of rollover, even if it's rolling over an old 401k into your TSP, you got to make sure it's done the right way, because every institution that does rollovers has their own way of doing it. Okay, so that's a big mistake that I see from a tax perspective that have cost people a lot of money. All right, tax mistake number 4, I get a lot of questions on this, and I know, and then one of the upcoming webinars we're going to be doing this year is the Roth versus traditional. It's one of our biggest topics. We typically have about 5,000 people on that. But this is mistake number 4, is not taking advantage of the Roth IRA or Roth TSP or 401ks. But in order to do that, the first thing you have to do is work the numbers. So let me give you an example. If you came into if you had an appointment with me and we were sitting down and I said, okay, I'm going to make up a name. Sorry if you're John on here. If I said, John, let me ask you, you want to go into Roth. Okay. The first thing we got to figure out is, if you go into the Roth TSP, number one, how much of your contribution is going to go into Roth? Number two, if you go into Roth, is it going to bump you to the next tax bracket, or is your contributions to the traditional actually helping you? Sometimes it's a double-edged sword. Let me give you an example of what I mean. So I would work the numbers with you. So let's just pretend that John is a single, when I say single employee, that means filing his taxes single. All right, John makes $60,000 a year. Now, if we look at our tax brackets, right, a single filer who's making $60,000 falls into the 22% federal tax bracket, right? You can see the brackets right there, 47 grand to 100 grand, falls kind of right smack dab in the middle of that. But remember, the IRS gives us this standard deduction of 14,600. So if we take 60 grand minus 14,600, we start off with that 45,400 of taxable income. Now, what does that do? Well, we're still, if you look at that, if you were to contribute all your money into the Roth TSP, you're still in a 22% tax bracket. No, excuse me, I'm sorry. You fall below into that 12 because it helped you with the standard deduction. Now, let's say you contribute $10,000 to your traditional TSP. Now you have a total contribution of 35,400 in taxable income. That has you in a 12% tax bracket, because you have up to 47 grand before you go back to a 22. So in this situation, your standard deduction helped you go into a 12. Your contributions to your traditional TSP also help you go into a 12%. So in this scenario, you could actually go all Roth and still be below the 47,000, which means you're golden. You could switch all and you would still be in a 12% federal tax bracket, which is great. However, what you have to pay attention to is, maybe you got some bonuses, maybe you got a little bit of a raise this year and you went above the 47,000. There are situations where if you're contributing $10,000 to your TSP, sometimes you have to go, 5,000 Roth, 5,000 traditional to get the best of both worlds, where you're still getting the opportunity to go into a Roth TSP and you still have some traditional, but it's keeping in the lowest tax bracket possible. So you have to work the numbers. The numbers don't lie. They tell the entire story about, how this helps and how it could. So if you come to me and you say, Ryan, I want to figure out if I should go Roth, should I stay traditional? The first thing we're going to do is work backwards on the numbers to figure out exactly how to take full advantage of the tax laws, keeping the lowest tax bracket possible while also maximizing at the same time. Okay, I hope that's helpful, because these are things you got to really pay attention to as you make these decisions. That's why I said earlier, look, I know this is a lot, but that's why I said the foundation of every financial plan or every financial decision has got to be made on the basis of taxes. If you're not doing it that way, you're going to make mistakes. Okay, so number 5, tax mistake number 5 is Roth conversions. This, now let me I'm going to slow down for a second and explain this. Being a tax firm, we have done more Roth conversions in the last 2 years for our clients than I've ever seen in my 15-year career of doing this, because of the tax laws that I'm telling you. These 2 years are so important with doing these Roth conversions, if this makes sense to you. Reason being is because what I told you before is there is more room between each tax bracket than ever before. There's, you have not just between each bracket, but even inside the marginal tax brackets to be able to do these Roth conversions. Now, a Roth conversion is different than a Roth contribution. A Roth contribution is what you put into your Roth TSP, your Roth IRA on the outside. Those have their limits, as we talked about. However, a Roth conversion does not have a limit. We have clients that have retired and have converted $100,000, $200,000 of their money from a traditional TSP to a Roth IRA on the outside to start doing these conversions. I'm going to explain to you what the benefits of that is in a second. But you have to figure out if Roth conversions make sense for you. There are several reasons why it's very important, but when should you do it? What are the tax consequences? And does it make sense for me to do it? So let's talk about why you do a Roth conversion. Number one, maybe you went through your entire federal career not really knowing how to take advantage of the Roth TSP. I hear that all the time. I know it's new for a lot of people. They didn't really truly understand it, but now you're starting to see the benefits of, if I go Roth, all the money in my Roth TSP, including my gains and interest, as long as it's been 5 years, is all tax free. So if you have $500,000 in a Roth TSP that's been in there for longer than 5 years, that entire 500 grand is tax free to you and your family. And that's important for two reasons. As we went back to talk about those distributions, right? Now, every time you take a distribution, it doesn't count towards your taxable income. It doesn't count towards, potentially making your taxable income higher, which then affects your Social Security, affects your annuity from the government, right? That's a great thing. You could take as much money as you want, and it doesn't ever affect those things. And the other part of it is, if you were to pass away, that money gets converted to your family tax-free. Whereas if they inherit your TSP, that's traditional, they have just inherited a full tax liability on that traditional asset. So Roth conversions can play a huge role. The other thing that this can play a really big role in is required minimum distribution down the line. And I'm going to talk a lot about that. If I'm you, and you are, now again, I'm going to be straight. If you have $300,000 or more, is typically when Roth conversions start making sense. If you don't have, if you're less than 300 grand in TSP or total assets, Roth conversions typically doesn't make a whole lot of sense, because the amount of income you're going to take from them eventually is going to lower a lot of the tax liabilities. But when you start getting to 300,000, 400,000, we do a lot of my high net worth clients that are 750,000 to 2 million that we work with. Roth conversion is almost inevitable that it has to happen to keep you as low in tax as humanly possible later on in your career. So if I'm you and you think Roth conversion is a topic that you need to talk about, again, write it down. A lot of you are going to have questions. Remember, at the very end, there's going to be a form that's going to pop up, and any questions you guys have so far as we go through this, write them down, put it on the form, and one of them from our team will get back to you and answer that. This is one of those questions that we get a ton of. Ryan, should I pay attention to Roth conversion? Does it make sense for us? And what we do is we simply go back and we run the numbers to figure out long term, do you have a tax problem? And if you do, let's have that Roth conversion conversation. Another thing you need to know when it comes to Roth conversions is it cannot be done inside TSP. They don't allow internal conversions. So if you're going to do a Roth conversion, you have to be prepared that you're going to have to move money outside TSP. That's another thing that's a personal thing, whether you want to or not, whether you care or not. But if you're going to build a full-blown tax plan, this has to be a foundational piece of it. For a lot of you, this plays a really important role in minimizing your taxes long term. I'll explain why in a second. Okay, tax mistake number 6. This I'm going to take a little bit of time on, because we're making good timing here. Taxes on Social Security. Now, for most of you, this is either going to be your largest or your second largest fixed income. And I've had the privilege of teaching Social Security workshops all over the country. And when I teach these workshops, it is amazing to me how many people truly don't understand how Social Security is taxed. And my God, it is so important, because what we have seen happen is people in the federal world, and even in the private sector, they'll go into their first year of retirement, starting to receive their Social Security, and do not withhold taxes from their Social Security. And they end up owing taxes their first year in retirement. That's not a good start. Let's be clear. If you were supposed to withhold, $4,000 in taxes at your Social Security and you don't, could you imagine filing your taxes your first full year in retirement, and your tax person comes to you and say, hey, by the way, John, you owe $4,000. And you go, what do you mean I owe $4,000? Well, you didn't withhold taxes on your Social Security. Well, I didn't know I had to. In some states, there's no tax on Social Security. I'm talking about federal tax. So I want to make sure we're being clear on that. Okay. This is a big secret, and I've seen a lot of people make the mistake of not withholding. So let's talk about how that works. The question is your Social Security taxable? Well, let's take a look at this. There's a formula, and again, I'm really not going to dive deep because I don't want to confuse everybody, but there is this formula called the provisional income formula. Very simply, what it is it's all of your adjusted gross incomes. So it's going to be things like your pension, your IRA distributions, your 1099s, your W-2s, all of the income. Now, if you're married, it's the combination of you and your spouse. If you're single, it's just you. It's a combination of all of that and half of your Social Security benefits. You add all that up, whatever that equals, you're going to minus standard deduction from that. And whatever that total formula comes out to be is how much you could owe in tax. So what does that mean? That means if you were a single filer and after that whole wacky formula, you make less than $25,000, there's no tax on your Social Security. However, if you make between $25,000 and $34,000, up to 50% of your Social Security could be taxable income on your tax return the following year. If you make more than $34,000 as a single filer, up to 85% of your Social Security could be a taxable income. So let's just do some math on that real quick so visually you can kind of understand where I'm going with this. Let's say that your Social Security was $2,000 a month, okay? And you're a single filer and you make more than $34,000 after the formula. Well, $2,000 times 12, very simply, but that's 24,000. That means that 85% of that 24 grand, which for simple numbers is 20,400, 20,400 of your total Social Security income is going to go on your tax return the following year as a taxable income. Now, what if you're in a 12% federal tax bracket times 0.112? That's $2,448 that you were supposed to have withheld. What if you didn't? What if you didn't know that? And that's a pretty low number actually, but what if you didn't know that and you didn't? And then all of a sudden, April 15th next year, your tax person says, hey, you owe $2,448. That's not a good conversation to have your first year in retirement or any time. That is a big mistake that a lot of people make. Now imagine just taking that number and doubling it times 2. Imagine if you and your spouse make more than $44,000 and 85% of both your Social Securities combined were taxable. And now you're supposed to have withheld almost 5,000 and you didn't do that. Could you see how that could be a problem? This is a common mistake that we have seen so many people make that do not understand Social Security. So my advice to you is this. If you're doing your own tax planning, fine. If you need help, let us know, we'll help. If you're working with an advisor and they have not talked to you about this, that's got to be a big red flag, because I have seen so many people that have come to us that maybe they have worked with somebody in the past, and my question is, okay, so what is the tax strategy for minimizing your taxes on Social Security? Well, we never talked about that. I mean, that's such an important piece because it's a foundational piece for one of your largest income streams. Okay, so know how it's taxable. If you have questions on this, which I'm sure a lot of you are going to, one of the things that we will do as complimentary for everybody is we will do a Social Security analysis for you, which very simply we can take the numbers, put it into one of our softwares. It'll tell you exactly how much Social Security tax you will have. You want to know that. There's no cost. So at the very end of this workshop, when that form pops up, put that down. Hey, I'm interested in getting a Social Security analysis done because that's going to be so important to make sure that you don't overpay. Okay. Now, let me show you what I mean. So here's a hypothetical example. You have a married couple here. You got Frank and Betty. Frank withdraws $12,000 from his IRA, but Betty's got a pension for $5,000 a year. Their Social Securities combined is 30 grand. So in this example, they have $47,000 of total income. Now, if we go back to our chart, right, 44,000 up to 85% of that is taxable. So in their situation, 47,000 puts them above the 85% threshold. However, remember I told you it's half of the Social Security and standard deduction. In this situation, they actually go below the 32,000. So there's actually no tax on their Social Security after the formula. And again, I'm not going to go through the whole formula because that gets more confusing. The point is you have to know the numbers, okay? After the formula, you got to know, and that's the things that we could help with, is making sure you truly understand what is taxable, what is not, because you don't want to have that issue running into retirement, okay? Now, tax mistake number 7. We got a few more to go here. This one, I can't stress it enough. This is one of the biggest silent killers of people's retirement. And the reason why is because when you turn 73, now these numbers are going to change. The required minimum distribution is going to go up, okay, in years. So it's going to be 74 and then 75, but right now it's still 73. So what that means is when you turn 73 years old, the IRS is going to add up all of your traditional IRAs, and based on that number, they're going to tell you and force you to take out a certain amount from your IRAs. Now, why is that a big deal? Let me give you a couple examples. I had a client had $1.2 million in their TSP. Now, that's a high number, and I'm going to give you a reason why I'm bringing that up. They had $1.2 million in their TSP. We found out that 400,000 of it had to be earmarked for the purpose of income. Okay, they literally only needed about maybe $20,000 a year from their TSP to supplement the income that they needed. Not a lot of money when you have $1 million. Okay, doesn't really even put a dent in the TSP with the growth on top of it. Great problem to have, really bad problem to have when it comes time for required minimum distributions. Why? Because as that keeps growing, as your traditional IRAs, traditional TSPs keep growing, the more the IRS is going to force you to take out. So if you have a traditional 401k, an IRA, TIA, 403b, TSPs, deferred compensations, 457, these are all subject to the required minimum distribution. Now, I want you to think about this for a second. What if you only needed $20,000 a year from your 401ks or your TSPs, but you have $1 million in your TSP when you turn 73? The IRS is going to force you to take 40 grand a year from that TSP, but you only need 20 to live on. What do you think that additional 20 grand that you don't need, that they're forcing you to take, what do you think that could do to your tax bracket? That, for most people, and I'm just sharing you, look, for most people that we have done tax planning with, that is the difference between a 12 and a 22% tax bracket for life. I want you to think about my stone in the pond analogy for a second. Think about the ripple effect that has. Imagine being 73, you retired at 63, and you have lived so comfortably off of your FERS annuity or your SERS annuity, your Social Security, and the 20 grand you needed from your TSP. Life has been great. You have been living in a 12% federal tax bracket. Taxes are good. You're not paying a whole lot. But then all of a sudden, at age 73, you now are forced to a 22% tax bracket because of the RMDs, required minimum distribution. Imagine now the ripple effect that has. Now you have to go back and you have to readjust your pension and withhold 10% more in taxes. You now have to go back and readjust your Social Security. What if that was a thing that bumped you to the 85% taxable on your Social Security? You went from having no tax on your Social Security to now being 85% of it's taxed. Do you understand? Are you starting to see how the ripple effect could really greatly impact you? See, this right here, this mistake, I call it the silent killer, because when we do planning with our clients, we have to look. Some of you are 50 years old, and we're going to talk about this, because we have to look 15, 20 years in the future to start making decisions today to help avoid that. What if you are 60 years old and we could build a plan that says, you know what, by the time we get to 73 or 74, we don't ever have to worry about RMDs being a factor because we have plenty of time to adequately plan. That's where things like Roth conversions play a massive role, because if you've got $1 million and you do those Roth conversions, or you have 500 grand, you do those Roth conversions, guess what? Roth IRAs are not part of the RMD calculations. Why? That's why I said Roth conversions for a lot of you could be your best friend. There's a lot of tax planning that goes into it, but what an opportunity you have to be able to save a ton of money long term. You might have to bite the bullet, early, but with the tax laws that we have and these next 2 years, can't emphasize it enough, this is the time to do it. So again, if RMD planning is something that you are concerned about and you need to make sure we focus on it, put it on the form at the end. Let us know. We'll make sure we've spent a lot of time with you on those RMD plans because that's so important. I see so many people make those mistakes. All right, now, so how do RMDs work? Well, here's right off of a RMD calculator. If you had $500,000 in your TSP and you are 73 years old right now, and you were forced to take the RMDs, this is what they would force you to take out: $19,531 and change. Okay. So again, we talked about what issues could this force you. Well, again, push you in a higher tax bracket, push your Social Security benefit to become taxable. Oh, and by the way, if you do not handle your RMDs and you don't file it, there's also a 50% tax penalty. Imagine if you owed $10,000 more than what you needed to in RMDs and you didn't file or withhold enough for RMDs and they hit you with a $5,000 tax penalty. That would hurt. That's also part of this. Now, again, you've got to make sure that this is in order. And you've got to make sure that if you're working with somebody, that they are talking about this. If they are not talking about this, red flag, okay? So important. All right, tax mistake number 8, taxes on pensions, not withholding from pensions. Now, when you retire, you're going to fill out this application for immediate retirement. Now, I would imagine most of you on here are FERS members, probably a couple CERS in there. Same thing, you're going to have to withhold taxes from your pension. Now, you have to make sure you withhold the right amount of taxes from your pension, because once again, you don't want to under withhold and then end up owing in your first year of retirement. And your first year is kind of wacky. You're kind of getting used to it. There's going to be times where you're taking these IRA distributions. Maybe you retired mid-year, and you worked half the year and your pension didn't kick in till later in the year. Your first year is kind of weird. You want to make sure that you're withholding enough. But one of the things that is not included in your application for immediate retirement is your state income tax form. For those of you that live in a state for income tax, that is not included. And I have seen a huge mistake where, because it's not included, people thought that the state was automatically going to withhold, and they do not unless you indicate for them to. So again, big thing that I've seen for those of you getting ready to retire, you got to make sure that you have the right forms for that. All right, mistake number 9, not understanding the new Secure Act and what that means for passing assets. So what does that mean? That means that I'm going to give you just one of the biggest ones here. There's so much that goes in the Secure Act, but one of them is no more stretch IRAs. What does that mean? That means that if you die, anybody other than a spouse, okay, anybody other than a spouse only has, that could be your children, only has 10 years now to withdraw all the assets that's withheld in that IRA. It could be your TSP, old 401ks. So if you have traditional money, $1 million in traditional money, your kids are going to inherit that $1 million. They are going to be forced to own the tax liabilities of that $1 million. They used to have the stretch IRA, which allowed them stretched out over 20 years. That's gone. Now your spouse, they're going to do a spousal inheritance. They'll be able to take it over as if it was theirs, and they're subject to the same tax laws, same RMD laws. But anybody other than a spouse, any family member, friend, anybody beneficiary, they only have 10 years now. So think about the tax complications that could cause for your family. What if you have a 30-year-old child that's kind of right in the prime of their working? They're just starting to, get those raises. They're making 75 grand a year, and then you die, and they inherit $500,000, and they have to pay the tax on that. What does that do to their taxable income? That could really force them to a bad situation. Now, if they inherited a Roth TSP or a Roth IRA, that does not hurt them. That's a tax-free retirement to them as well. Roth conversion could be a really important key for estate planning as well. Again, make sure you have your wills and trust updated. If you do not, write that down. You want to have your wills and trust updated regularly. Make sure you have one in place. All right, tax mistake number 10, assuming you will pay less taxes in retirement. So I've been doing this for 15 years now. Like I've said before, we ran a poll. 63% of our federal clients were in the same tax brackets that they were when they retired. Let me repeat that. 63% of our clients are in the same tax bracket they are when they retired. Why? Because unlike the private sector, you will have a very unique opportunity in your federal retirement where you have a pension and you have Social Security and you have TSP distributions. You have 3 sources of income, which we call the 3-bucket stool in retirement. Most of you will be in the same. So do not underestimate that. Some of you say, you know what, I'm going to keep deferring my TSP because when I retire, I'm going to be making less money, be in a lower tax bracket. I'll be paying as much in taxes. For most of you, that's wrong. The other reason why you may not be paying less in taxes because some of you that will be forced into those required minimum distributions will keep you where you are. So do not assume you will pay less taxes in retirement. And also don't assume that the tax laws aren't going to change to where we're all going to pay more taxes later on. You're going to tell me that taxes in 10 years from now are going to be cheaper than they are today? There's no way with the way that we are and with our economy. Do not make that assumption, okay? It's so important to plan for the worst, hope for the best, but plan for the worst. That is a strategy. Hope is not a strategy. A strategy is a well thought out strategic plan that encompasses all the pieces to the puzzle that we just talked about and making sure that every piece is built on the foundation of taxes. If you do not do it that way, you will have and fall into some of these traps of mistakes. I hope it's been helpful for you. Every one of you are going to get a form that's going to pop up. If you have questions, fill out that form. Let us know. Someone from our team is going to call you and personally answer every one of your questions. Thank you so much for being on. We look forward to helping you. We'll talk to you soon.